If someone says, I can beat the market, try taking the rate of return achieved by that manager and all other like managers, and you will deduct from it the fees charged, and there are very few who, over a long period of time, do better than the market.
Well, the best study I know of was one carried out in the States over 35 years, from 1970 to 2005. Matt looked at 355 funds. Just 9 of those funds beat the index by 2% or more over that period, and just 3 of them showed sustained outperformance.
We can't systematically all pick the winner. So the challenge now is, okay, can I find those great active managers? In fact, I don't actually argue there are no great active managers. I'm willing to say, yeah, maybe there are some out there. My problem is I don't know how to identify who they are.
The idea is to gather assets. The idea is to bring in as much money as you can and manage it. And if that product fails, you could then take that money and convince the client to go into a different product that you're coming out with.
We all get a return from the stock market in the long run. Now, let's say for the purpose of argument that that's an 8% return. But we in the markets get the net return after the insanely high costs of financial intermediation. And those can be as much as, say, 2% a year. Wall Street, if you will, in America, gets 70% of the return and puts up none of the capital and takes none of the risk. And we get 30% of the return, we investors as a group, there's no way around this, for putting up 100% of the capital and 100% of the risk. That is just crazy.
In the 60s, economist William Sharpe developed the capital asset pricing model, for which he was later awarded a Nobel Prize.
It has to do with the relationship between the price of a security, its risks, and its expected return. And there are really sort of 2 key takeaways, if you will. One is that in that setting, the most efficient strategy for an investor is to hold basically a broadly diversified portfolio reflecting the market of securities that are available. And that gave birth to the notion of index funds. And the second is that there will be a reward in higher expected return, not guaranteed, but expected.
After the capital asset pricing model came the efficient market theory, developed by Eugene Fama and Ken French. The idea being that shares are always priced correctly because they already reflect everything that's publicly known about a company. More and more Americans were beginning to realise that paying a manager to buy and sell individual shares was a waste of time and money.
So there's a return advantage to passive investing, and then I also think there's a risk advantage in that when you're investing passively, you're basically trying to capture market returns. So you are not going to be surprised by your investment manager's underperformance, or you're not going to be heavily concentrated in a few number of securities where the risk would be that if those securities do poorly, that your results will be very bad.
There's a rule in real estate that the 3 most important things are location, location, location. Well, my rule in investments, the 3 most important things are diversify, diversify, diversify.
In 1973, an American economist named Burton Malkiel wrote a book that's become a classic. It's called A Random Walk Down Wall Street. Now, although he backed it all up with detailed statistics, charts and studies, his argument is a simple one. You can't predict share prices. If you do manage to beat the market, it'll be more than likely down to luck. Even then, transaction costs will likely cancel out any extra returns you make. As for picking the next star fund manager, you might as well forget it. To quote the author himself, a blindfolded chimpanzee throwing darts at the stock pages could select stocks as well as the experts.
Every time I do a new edition, the 10th just came out, I ask myself, is the hypothesis true? Do index funds outperform? And every time I do it, I find that index funds do better than about 2/3 of the actively managed funds. And then, when I look at it in the next period, I find exactly the same thing, and the 1/3 that beat the index in one period aren't the same 1/3 that beat the index in the second period.
In fact, despite there being a wealth of evidence in favour of passive investing, produced by some of the world's most distinguished economists and statisticians, the intellectual case for active investing has been almost non-existent.
I'm Dan Richards. I'm talking today from the University of Chicago Booth School of Business, and I'm speaking with Gene Fama, broadly acknowledged as the father of modern finance. Gene, one of the pieces of research that you're best known for, and one of the most influential and important, relates to some work that you and Ken French did years ago on the three-factor model. Suggesting that, in fact, the traditional view that the only thing that predicted future returns was beta or volatility, in fact, was taking too narrow a glance.
So we're basically saying at least two more sensitivities are important in describing how average returns differ from one another. And that's caught the attention of academics and practitioners.
Yes, what surprised me when I spent almost 3 years collecting historical returns in the United States first and then other countries was that although the stock market was very volatile in the short run, we certainly know that, in the long run it displayed a remarkable stability. I put a trend line over 200 years of stock market data, and no other asset class clung to the trend line the way stocks did. It's very interesting if you look at U.S. data that there has never been a 20-year period where you've lost purchasing power by investing in the stock market. And that includes all the bad 10-year periods like the last 10 years also.
So, to summarise, regardless of the impression they like to give, fund managers regularly produce less than the average market return. Buying and selling shares is little more than a gamble, and strong returns are often down to luck. It's harder than ever before for a manager to outperform the market consistently. Commercial pressure means fund managers often advertise funds they wouldn't choose for themselves. And remember, although there are good managers out there, picking the next star manager is almost impossible.
The world of investment professionals and financial planners is dominated by salespeople who only get paid when they sell you stocks, bonds, mutual funds, or insurance products. You're skeptical. How do you determine if the advice you're receiving is truly in your best interest and not theirs? Fortunately, there is a better way. A fee-only investment advisor acts only in your best interest, much like your doctor or attorney. The business model is simple. A fee-only planner provides objective investment management and financial planning. Period. No commissions, no kickbacks, just a single fee. Sounds great, right? But how do you choose one? Even many fee-only advisors are stock pickers or market timers. However, all the academic evidence suggests that you're playing a loser's game when you attempt to beat the market. Wall Street gets richer and you'll be poorer. The better way is to focus on things you can control. how much risk to take, what mix of investments, how much the investments cost. But that still leaves you with an ocean of possibilities and many questions. That's where we come in. Our mission is to provide you the tools and guidance you need to build wealth with simple disciplines. You've made it this far. Now, let us help you get there.